Hi, everybody, and welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
Hey, hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rate. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. And this week we're going over a stock in the automotive business, and that is Tesla. And they came out with earnings just the other day, and the stock has been falling ever since. But let's take a look and see what this company is doing. And remember, folks, here's another picture of the beach. If you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And Tesla, well, we all know what it does. It engages in the development and manufacturing of fully electric vehicles, EVs, and batteries, and developed the Roadster, the first commercially produced, federally compliant highway-capable electric vehicle. The Model S has a range of up to 391 miles, and it's a little bit more than that now, I heard, per charge, and the crossover Model X up to 325 miles, Model 3 up to 322. Now, Tesla operates its own vehicle sales and services network, and it acquired SolarCity in 11 of 16, has about 48,000 employees. Meanwhile, let's look at a few things about Tesla. All cars are or will be mandated by the government in the future. And didn't our president just come out and say he wants all military vehicles electric by a certain year? Question mark. And that's going to be hard. You might not find charging stations out in the jungles or in the deserts someplace else. But anyway, we'll see how that works out. Anyway, Tesla's a brand name relative to its product, just like Heinz or Coke. And when you think of a cool soft drink, you think of Coke or Pepsi. When you think of ketchup, you think of Heinz. And when you think of tissue, you think of Kleenex. Now, when you think of electric vehicles, you think of Tesla first before General Motors or before Ford. Now, Tesla doesn't use dealerships, thus saving a big cost of a new car. And you'll see it in some dealerships, but it doesn't have its own specific dealerships as of this point. And the question is Tesla a battery company? And boy, it's doing a few things out there near Austin, Texas, with a big new battery plant. And does it make charging stations, or will it make charging stations? And then, of course, you have Elon Musk, who is an entity in and of himself. Well, let's look at some numbers, because this year, well, I don't know if it was this year, but recently the Tesla lowered the prices on its model cars about 5 times in a row, and then just the other day, or just the other week, it raised some prices on some cars. And what Elon Musk says is he would rather have market share than profits at this particular point. So that's something we have to think about. He's preparing for the future. Now, this 2022 number was lowered a little bit, and this 2023 number, there's a question on that, because of him lowering the prices 5 different times and then raising them a little bit. And this number could be as low as $3.44 by some of the lower estimates. So what's
happening to the stock right now is that this number is definitely in question. So if this number does go down to $3.50 or $3.44, that'll bring this clean surplus return on equity down to about 18%. And that will affect the net income growth, because one of the things that we look at is this stock is selling at about 50 times earnings. So a price to equity ratio of 50 is very, very high. The thing is, when we talk about the PEG ratio, which is the PE ratio divided by the net income growth, that gives us another whole set of numbers to look at. So what the PE ratio does is it doesn't bring into play the growth of the earnings. And when we come back here to net income, remember net income is represents the clean surplus earnings. You take traditional accounting earnings, you subtract non-recurring items, you subtract future liabilities, and you come up with a clean number that is comparable between companies, because this is exactly what the company brings in minus all the other stuff like private jet airplanes and private cars and this, that, and the other thing. So the net income is a pure number that we can look at as a bank account, because when you think of a bank account, what do you think of? Well, what's the interest rate it's paying me? It gives you a bottom line number. And that's what the clean surplus net income does. So we can compare companies when we get a clean surplus return on equity, just as we do interest rates on a bank. And that's very, very important. And you can see this clean surplus return on equity is high. To get into our growth portfolio, we look at 20%. And this company is above that. Plus, it's going up. And that's what the markets want to see. However, is the growth at 127% on average, is that a real number we could look at? And the answer is no, because when you come from negative earnings into positive earnings, that number goes up quite a bit. So this number is tainted, and we don't know what the true net income growth is until we get this 2023 number finalized. Revenue growth averaging 32% a year. That's very good, folks. That's very, very good, because the average stock averages revenue growth of about 7 to 7.8% per year. So 32% average over 5 years is very, very good. Years to pay debt, and that's Buffett's rule of thumb. If you take all the money the company is making and just use it to pay off debt, how many years will it take to pay off debt? And the answer is 0.3, which is about 3 or 4 months. So it doesn't have any trouble with debt. So let's see how this company has done over the past 1 year. It has totally underperformed the S&P 500, with the S&P about a negative 5% over the past year. This company is down a negative 45% for the past year. When we look at 5 years, black line's the S&P 500, up about 50%. This company is up about 700%. And you can see the fall it has taken. This all in here is 2022, and you can see the fall it has taken, and now it's starting to rebound nicely over the past 3 or 4 months. So right now we have Tesla in our growth portfolio, and we think that we may be nearing a buying situation or adding to the portfolios, because this stock is actually filling in a gap it made several months ago, and it might be filling in nicely here. So we might be looking to add to our portfolios a little bit, not going crazy over this, because we have this stock way back over in here where we bought it really quite low. So anyway, we might add a little bit to the newer portfolios right around here, because it seems to be bottoming out after the fall in here. This entire fall in here has been a pretty big move to the downside, and that was because the company lowered the prices about 5 different times on its various models. So we're thinking that it might be holding in here a little bit, and we're adding a little bit to our portfolios. So far, Tesla is the leader in the electric vehicle market. Musk is putting on building a whole new battery plant somewhere in Texas near Austin, I believe it is, and he's looking at the future. And don't forget, electric cars are going to be mandated or are mandated in certain places and will be by a certain time. All we have to do is get the power grid to handle all that electricity that's coming from the power plants. So yeah, we like Tesla, and it's in our portfolio. And don't forget, our growth portfolio has about 30 stocks, actually 31 at this present time. So it's one of those stocks that are in our portfolio. And remember what Kathy Wood of ARK Investment says, that it's going to be a $2,000 stock. Don't know exactly when, but that's what she's calling for. So Tesla has room to grow because electric vehicles are being mandated.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.